This is a pretty seismic shift in the currency markets, is it not?
Psychologically, it's a huge level. As you say, we haven't traded down at these levels since the very early days of the euro in the early 2000s. And I think for a lot of people, parity is just a huge technical, psychological level. From an economic perspective, the move in the euro hasn't been quite as big, but certainly it's eye-catching to everybody looking at euro dollar in particular.
You know, we like round numbers here in the media, so 1-to-1, 1.00000, whatever it is, also kind of gets the flashing headlines, but it's not the be-all, end-all. No difference between that and a couple of cents above or below. You think we're going to continue to trade down? I mean, this 1-to-1 mark sounds like it could just be a toll booth on the way lower for the euro.
Yeah, though it is interesting as we got very close to that level yesterday, and as we saw it trade on certain exchanges, we did actually see a lot of interest on the bid side in euro dollar. So there's certainly a lot of people willing to pick up euros down there, whether it's people defending levels in the options market or people looking to pick up euros from a longer term perspective at what they think is a cheap level from a valuation perspective. But I do think that given the economic outlook, the cyclical outlook, and as you mentioned, the European energy outlook, there is certainly scope for euro to keep trading lower. The market is positioned short euro dollar already, but that's certainly no obstacle to seeing 98, 97, even something below that trade in some extremes.
Also, the world is priced in dollars. Oil, so many other commodities. I got a note yesterday from a friend of mine who's a former Goldman Sachs partner. He basically said to me, and I'll summarize, don't underestimate the global impacts on everything, including sovereign debt, from this move in the euro dollar. What kind of ripple impacts might we see?
So it's the US dollar strength that really matters then. As you said, the world is priced in dollars. Commodities tend to be priced in dollars. And it's the fact that we're seeing US dollar strength coupled with some very aggressive rate rises from the Federal Reserve. We haven't seen that for a very long time. These 75 beep moves and people even talking about the potential for 100. It's the fact that you're seeing that combination of a strong US dollar, strong energy price inflation, food price inflation, and coupled with higher US rates that's putting a lot of pressure, particularly on emerging markets.
So what happens if we see a 90-cent euro, Elsa? I mean, what does that mean for Greece's debt, for Eurozone debt, for the price of oil? We talk to your colleagues who cover those markets. They'll bring this up as well. What is that going to mean to those markets?
So the real challenge the euro area has at the moment is figuring out how to raise interest rates in the face of what is relatively weak domestic demand, but also, as you mentioned, some of the spread widening that we've seen in peripheral debt markets. At the moment, they've promised us that they're going to come up with this anti-fragmentation tool to announce at their meeting next week. Remains to be seen if they'll actually be ready to present it to the world at that meeting. But in the absence of that, it really the ECB in a very tricky situation. And I think that's part of the reason why, despite the 12% move lower in euro dollar, we still see some further room for euro dollar lower still.